intensifying war that's showing no signs of ending anytime soon. Well, while announcing the aid requests, President Biden weighed in on the latest GDP report that shows a 1.4% contraction in the first quarter.
What you're seeing is enormous growth in the country that was affected by everything from COVID and the COVID blockages that occurred along the way.
The president says he's not concerned about a recession this year, but says it could happen in 2023. He's calling on Republicans to work with him to lower the deficit. The FDA is proposing a ban on menthol cigarettes. FDA Commissioner Dr. Robert Califf says it is a move that will save lives.
Prohibiting menthol in cigarettes would mean over 18.5 million menthol cigarette smokers ages 12 and older in the United States would have a better shot at quitting. This translates to better health and lower risk of premature death.
Dr. Califf says menthol-flavored cigarettes make smoking more attractive for those younger users. This is expected to also affect black smokers, with 85% of them smoking menthol cigarettes. Trevor Reed is back home. The Marine veteran who had been imprisoned in Russia landed at a San Antonio Air Force base just after midnight. He was part of a prisoner exchange between Russia and the U.S. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nancy, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. So earlier this morning, we were taping for our weekend show, and we caught up with Joel Weber, editor of Bloomberg Businessweek, and Christina Lindblad, who is economics editor of the magazine. And the cover, and there's a whole takeover in the economics section that's all about what's going on in China, and a lot of it is related to, of course, the COVID lockdown and what it's doing to the Chinese economy.
Yeah, it's really notable because China was well, obviously that's where we think the virus emerged, and early on, before it made its way around the world, we saw images of people in Wuhan under lockdown. That lockdown now, 2 years later, is taking over Shanghai, and it's even a stricter lockdown in some places. There are concerns about Beijing, and there are serious economic repercussions, not just for China, but also political repercussions for China, President Xi Jinping, and then serious global economic issues throughout the world as a result. I mean, look at the number of ships that are just waiting to actually get stuff and unload that stuff in China, too.
Right, we talk about it all the time in terms of supply chain. What's interesting about this one story that's on the Bloomberg, talks about President Xi being in a bind over who to blame for Shanghai's COVID outbreak. There's a lot of expats there, very evolved city, if you will, right, in terms of a lot of foreign companies being there and exposure. So this story asks, who pays the price for China's current COVID crisis will show the strength of President Xi Jinping's grip over the Communist Party heading into a crucial leadership reshuffle. This is why there's just so much stuff happening on, but it's very political or has political implications.
Yeah, Joel and Christina earlier in our Editors Roundtable, which will be available on Bloomberg.com and wherever you get your podcast this weekend, talking a lot about the political repercussions here. Remember, Xi last month renewed his threat to punish anyone who fail in their virus-fighting duties. Only 15 low-ranking officers have been disciplined, officials, I should say, over the weeks-long lockdown in Shanghai. So criticism of the financial hub's performance risks blowing back on Xi, since it's run by one of his closest associates in the decision-making Politburo.
Yeah, really interesting. And there's a lot in terms of the economic statistics coming out and how important it is for Xi that it outperforms globally. Check it out, though.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks are up the most in 6 months. They continue to rally into earnings from Apple and Amazon after the bell. Facebook reported last night. Facebook shares up by 18.1%. Qualcomm after earnings up now by 9.6%. S&P higher by 112, up by 2.7%. The Dow up 672, also up by 2%. NASDAQ up 414, best level of the day right now, up by 3.3%. NASDAQ 100 index outperforming, up now by 3.8%. 10-year is down 8/30 seconds. 10-year yield 2.86%. Spot gold up $4 the ounce to $18.90, up 0.2%. West Texas Intermediate crude oil up 3.3%, 105.28 a barrel. Stocks are gaining as strong earnings from tech heavyweights bolstered optimism that corporate profits can withstand an aggressively restrictive Federal Reserve. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, I got to say, Tim, it's not easy being a company today. Employees and consumers and customers and investors kind of wanting you to take a stand on important issues sometimes.
Yeah, and then there's the whole, maybe quote-unquote problem of high-level executives using Twitter.
Yeah, it doesn't always work out well, despite what Elon does.
Well, that's sort of, we're talking about this because if you recall, it's a story that centers around a Levi's executive. You might have heard of her over the last few months, who's no longer at Levi's. Well, our own Claire Sidath, a columnist at Bloomberg Business Week, who joins us now on the phone from Brooklyn, is the author of that story. Levi's finding itself thrust into the culture wars by a rogue executive. Joining us now is Claire, along with Joel Weber, editor at Bloomberg Business Week. He joins us on the Access line from Brooklyn. Joel, I think for a lot of people, they might not know the name Jennifer Say, or did not know it until just a few weeks ago, despite the fact that she's been a high-level executive at Levi's for quite a bit of time.
Yeah, Jennifer Say rose through the ranks at Levi's for years, actually, and eventually became a brand president and was in charge of Levi's marketing. She was the chief marketing officer. So it would basically set her up to be potentially the next CEO at the company. And she was very, very good at her job. And where the rest of the world, maybe you've heard of Levi's, and since it's basically a old school Americana brand that she helped turn around, frankly. But if you hadn't heard of Jennifer Say, you may have when all of a sudden in February a spat between her and the company became the reason that she left, and that made us very interested in her. And Claire Sidath immediately started going on a bigger story, and what she found, I think, is pretty remarkable, and it's really this complete tale of Jennifer's sort of transformation inside Levi's, and it also gets to a bigger story that I think we're all really interested in right now in corporate America, which is this tension between companies, their images, the tension that social media creates, and you just think of Coke, Disney. Now, we'll talk more about Levi's here. This is a challenge for all kinds of American companies all of a sudden. So, Claire, tell us about Jennifer and what you learned. Obviously, this was all over the headlines, but you dug deeper. What did you find out?
Well, like you said, Jennifer was the head of Levi's marketing. So all the advertising, marketing, branding, Levi's, that's what she was in charge of. The company for years was also incredibly progressive, way back until the 1930s. More recently, in the past decade or so, they've come out in favor of gun control, marriage equality, transgender rights, et cetera, et cetera. And she was also part of the executive team that sort of shaped that narrative and talked about, when it was appropriate for Levi's to say something and in what way. But then during the pandemic, we've all found the pandemic really hard, and she was stuck at home with 4 kids. And so she started tweeting her views on COVID, but they were, I would say, rather contrarian. I would say as early as April 2020, she was calling for the country to open back up. Her pet topic was school reopenings, which, now kids are back in the classroom now, but in 2020, when no one really understood the virus, it was much more controversial. And, within Levi's, employees started to become really upset and saying internally to HR, to legal, to the CEO himself, why do we have an executive who's saying all this stuff on Twitter? Some of it is in direct contradiction to company policy. And it was like a 2-year-long internal struggle of Levi's trying to handle this diplomatically internally. Ultimately, it told her she couldn't hold her position as brand president and she'd never be CEO. And so she quit in a very dramatic fashion and said that she had been silenced.
So what's interesting, Claire, too, as you note in your reporting, Levi's is known for being a pretty progressive company for years and taking positions on controversial issues.
Yeah, and that was sort of Jennifer Say's argument is Levi speaks out on so many things. Why was it not okay for me to speak out about COVID? But I think, the issue is really, one executive going one way and all of these employees, to sort of rank and file employees saying, we do not agree with this. We don't like this. They had town hall meetings. She went on Laura Ingram's show on Fox News. People didn't like that, and they were saying, why is the Levi's executive talking to Laura Ingram when Laura Ingram has explicitly said things that this company stands in contradiction to?
Can I just jump in?
Yeah.
Didn't she know she was going to get into? No offense, but she seems like a pretty smart lady and understands branding and marketing. Didn't she understand, despite understanding it was a progressive company, know that by going on Fox, you send pretty much a clear message, and you do, because of the company you work for, that it's going to come back at the company, to be quite
well,
fair.
When I talked to her, she said she didn't know really anything about Laura Ingram. She never watched Fox News. But she was the person who oversaw Levi's advertising budget and just was in charge of marketing and had her finger on the pulse of the culture, that it seemed, it required a leap of faith for me to take her at face value and think that was really the case. But that was her claim, is like she didn't really know, she didn't realize why this was such a big deal. And also she said, just because Laura Ingram has said all these other things, why can't I talk to her about what I care about, which is school reopening? And employees were not having that excuse.
Claire, I'm interested because so many companies find themselves thrust into the culture wars now. What, if any, were the takeaways at Levi's after this is all? They get sucked into this fight that they maybe didn't necessarily want to have. Like, what are the takeaways, and what are companies to do?
And just got about 40 seconds. Yeah.
Well, it's funny because when I talked to Levi's about this, they were like, this is a kind of a unique situation. Most of the time, companies' culture thrown into the culture wars are because the company did something and people get upset, and this is one person internally in the company. And so it was sort of a lose-lose situation. If they'd ignored their employees, maybe their employees would speak out and said they listened to them, and then the executives spoke out. I think what the takeaway is this is incredibly hard, and one day you might find yourself faced with a public scandal.
Well, just talk to Bob Chapek right now. I'm sure he has some thoughts on that. A really great story. Thank you so much. Business Week columnist Claire Sedeth joining us on the phone from Brooklyn. Of course, Joe Weber, editor of Bloomberg Business Week on the Access Line in Brooklyn. Be sure to check out the new issue of Bloomberg Business Week. It is on newsstands, online at Bloomberg.com, businessweek.com, and of course on the Bloomberg terminal.
Yeah, one part of the story that Claire really gets into in this is Levi's long history of being early when it comes to progressive causes, being the first company to offer same benefits to, same-sex partners.
Jeans for women.
Jeans for women in the 1920s, I think, 1940s.
Yeah. It's a great read. All right, you're listening to Bloomberg Business Week. We're going to check in with our TV colleagues and talk about the markets in just a moment.
the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. 60 minutes left to go here in the trading session on this Thursday afternoon. Romaine Bostic, Taylor Riggs, Katie Greifeld in for Caroline Hyde. We're joined right now by our colleagues, Carol Massar and Tim Sinovic. We welcome our audiences across Bloomberg Television and radio, as well as on YouTube. And Carol, a broad-based rally.
Yeah.
Once again, yesterday it faded. Today it looks like it might hold.
What'd you do at noon? Because stocks just took off like a rocket. Did you do something?
I was taking a nap.
A nap again. All right. Well, certainly not taking a nap is chip stocks. Philadelphia Semiconductor Index, the stocks up almost 6%. Thank you, Qualcomm, which is up about 9% today following its earnings last night. Qualcomm is about 8% of that index. Keep in mind, Intel is about 9% of that index, and we'll get those results after the closing bell. SOX is up, but it's still down more than 20% so far this year, Tim.
All right, SOX is up. ARK Innovation ETF is down. The flagship ETF at Cathie Wood's ARK Investment down about half a percentage point right now. It's down for a third day in a row. It actually hit a 52-week low today. In fact, hitting levels last seen in April of 2020. Just to speak to the breadth of this rally, it was down as much as 7.4% earlier, but has recovered quite a bit with that rally. A big part of that being dragged down by Teladoc, down more than 40%.
Yeah, Tim, really good as you bring in some of the micro stories that want to just sort of broaden out and paint a picture of where we are for the major averages. Dow is up, S&P is up, NASDAQ is up, NASDAQ 100 is up, the Russell 2000 is higher, the chip stocks are higher, and of course the New York FANG index as well, also leading here up about 5 to 6%. And Romaine, I do this for you, an equal weight S&P that is also up 2%. And so we're really seeing broad-based rally,
I think that's a contrarian signal.
Broad-based rally. I love how much green is on that screen. If you look at the sector level, you have even more green to look at. Communication services is your biggest gainer on the day. That's thanks to Meta. It's thanks to Match, Netflix. The list goes on. Infotech, close second. Even the worst performer on the day, utilities, still up by over 1%. I mean, the breadth is just incredible on this Thursday.
Yeah, incredible here. Of course, we talk about Meta, Facebook, Meta platforms, whatever you want to call it. FB is your ticker, 18%. That's the gain on the day. Best day for the company going back to 2013 on the back of surprising resurgence and growth on the Facebook platform itself. Not the metaverse, not all the newfangled stuff that Mark Zuckerberg is working on, but the old school stuff there. You were just talking about Teladoc and ARK just a minute ago there, Tim. Of course, ARK is Teladoc's biggest single shareholder out there here with about a 12% stake. Those shares down a whopping 42% today. A lot of that on the back of higher expenses related to advertising costs, as well as a change in some of the plans that companies have here. That's kind of weighing on their earnings today. But again, when you look at the mix in that ARK Innovation ETF index, what Teladoc is a big player, all the other major names in that ETF are moving higher here on the day. Take a look at Pilgrim's Pride. Those shares higher by about 9% here on the day. And this goes back to some of the macro and inflationary issues. Chicken prices, they've been going through the roof. But you want to know what Pilgrim's Pride says? People keep buying. And one of the reasons why, it's still one of the lowest cost proteins out there. So relative to beef and pork and some of the other things, chicken ends up being a ballast. And I put this up here for you, Carol, here. Apparently no one's buying pizza anymore. I'm not sure exactly what happened, but same-store sales over at Domino's Pizza were just abysmal.
I have pizza every Friday night.
Not Domino's, though, right?
Not Domino's, every Friday night.
Do you? Okay, well, there you go. You need to buy more because those shares are down 3.4%. You see if you can, Carol Massar can give them a little bit of a bump next quarter.
Well, let's talk about a little bit of a bump that we did not get in the last quarter. Carol, I want to bring in this chart here of GDP. A lot of economists were coming out and looking at a 1% increase. And, well, this, at least the headline number, surprised to the downside, a drop of 1.4% on an annualized rate. But I think something that we've heard throughout this program all day today from economists is that if you strip out some of the trade data, the actual fundamentals underneath GDP still really looked good. The consumer here still looks strong. I was reading an interesting note over at Morgan Stanley, Ellen Zentner, and she said within that GDP report, the good news is that core PC inflation as well also came in lower than expected, but you're still at a 5.2%. But at least underneath the surface, the numbers looked better than that bad headline number.
Yeah, isn't it wild? I really thought when that GDP number hit, the first time we saw the economy retract since 2020, I thought, wait, there's going to be some impact on the markets. But as you said, consumer spending held up. Business spending also, we saw some strength there. Gina Raimondo, the U.S. Commerce Secretary, actually caught up with our Joe Matthew, and she too seemed to kind of brush off concerns about the U.S. economy. Check it out.
If you look at small business starts, they're higher than ever. Wages are up. You talk to CEOs about their businesses. The economy is resilient and growing. So at this point, obviously you don't want to see this, it's disappointing. You never want to see it, but we weren't surprised, and I don't think it's a trend.
And then, of course, Gina Raimondo, the U.S. Commerce Secretary, earlier on Bloomberg Television. I guess that's, the predicament we are in, right, guys? Where we see it in the earnings reports, some people who can manage through this environment, some who cannot, and that's where investors, that's why one day we have some selling, one day we have some
Well, this
buying.
goes back to the whole idea of just how disruptive the market has been, or I should say the economy has been, and why it's so hard to get a good read on it. Like we said, when you strip out some of the trade effects and, of course, those inventory effects, then you get a GDP number that ends up looking a lot better. And the question is that...
Is it the economy that's so destructive, or just certain factors, whether it's supply, like we can identify the specific factors?
Right, but the problem is how do you sort of model that when you don't really know when it's going to end or maybe how it's going to end? I think that some of the upbeat tone that you're hearing, not just from the administration, but from other economists as well, including a couple we've had on the program today, I mean, they all point to the idea that it's really about consumer spending, and if that holds up, you can sort of right-size the supply chain issues with relatively little damage, I guess, to the overall headline numbers down the road.
Yeah, I'll add to that list of economists and members of the administration, executives at companies that we've heard from over the past week about the strength of the American consumer. Listen to what Whirlpool's CFO James Peters said. We remain very confident that the fundamental strength of the consumer demand trends will remain intact over multiple years. Similar comments from Polaris CEO Michael Speetzen on the earnings call earlier this week. The consumer is strong.
All that being said, I mean, you do have to wonder what this means for the Biden administration. I think it was Bloomberg's Chris Yancey who made the point on the Markets Live blog earlier today that, when you're explaining, you're already losing.
Yeah.
And of course, there's a ton of nuance to this report, but the headline, I mean, that does hurt.
I think one thing we know is it doesn't mean much here for Federal Reserve, still on track to hike about 50 basis points. That's what the markets are looking for, and remain a balance sheet reduction of about $1 trillion on an annualized basis as we try to get off the lofty levels of $9 trillion.
Yeah, and look, I mean, Powell has sort of talked about this ad nauseum, the idea that you could sort of have that proverbial soft landing. I mean, he points back, of course, to the Greenspan era hikes in 94, 95, where you basically had 3 full percentage points going in a single year, and he tamed inflation, and he did it without causing a recession. That's, I guess, his golden child right now that he's pursuing.
Just going to say Amazon, Intel, we'll see whether or not the momentum continues after they report, which we will be breaking down in just about an hour's time. All right, guys, we got to run.
Do you not care about Apple?
Oh yeah.
But we're not going to be together for it, probably.
Yeah, that's going to be.
Okay, so it doesn't count.
Yeah, 4:30 is when we get those
that's
numbers.
why you're not mentioning
Yeah, I'm thinking about the things we do as a family here. All right,
Pizza night, Domino's. That's what we'll do as a family.
Yeah, exactly.
goodbye,
Romaine,
guys.
you bring the pizza.
Bye.
We'll be back in less than an hour's time. TV, radio, YouTube, Beyond the Bell, coming your way. We're going to count you down to the close on this Thursday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you're listening to Bloomberg Business Week. Carol Masser along with Tim Stenovic. We do have a bunch of big earnings. I don't know how I forgot about Apple.
Well, because we're not doing it at 4:05. I mean, Apple, I will tell you, as somebody who's covered Apple for years, it's just like so annoying that we have to wait a half hour. I mean, it gives us time to digest Amazon
What do they want?
earnings,
Just all the time to
earnings, and
themselves?
Intel.
Like get through all the other stuff?
I don't know. I don't know the answer. But
Shares of Apple up 4.6% ahead of that earnings report. So outperforming even the broader market and the gains that we're seeing in tech. Still down about 8% this year.
I was thinking, do you think Apple's an important company to watch in terms of the consumer health? And the reason I ask that is because it's such a high-end product, not just in the United States, but especially globally. So does it give us an accurate read on how the normal consumer is doing?
The only thing I would say is they sell a ton of stuff.
Yeah.
So their consumers, whether they're high-end or not, buy a lot of that stuff. I mean, we're looking at revenue projections for the 2022 year of like $395 billion.
The numbers are in an absolute different league. Carol, but I'm also looking for any information about the company when it comes to production, especially in parts of China that have been under lockdown or faced COVID, because that's been an issue for suppliers, not just for Apple.
And the Qualcomm was very upbeat. So does that, as Qualcomm is Apple is their biggest customer. So
Right.
does that translate? I don't know. I guess if they're having any kind of problems, any kind of slowdown though in purchasing, if even the higher end consumers having problems, that would make me a little nervous.
Okay, 4:30 is when those numbers are crossing.
Apple's crossing?
Yeah.
Okay, got it. All right, let's get back to world and national news. Over to Nancy Lyons in D.C. Hey, Nance.
Thanks, Carol. President Biden asked Congress today to appropriate an additional $33 billion to help Ukraine with military and humanitarian supplies until the end of the budget year in September.
president said the money Congress previously voted is running out as the Ukrainians attempt to free the rest of their country.
We need to contribute arms, funding, ammunition, and the economic support to make their courage and sacrifice have purpose. The cost of this fight is not cheap, but caving to aggression is going to be more costly if we allow it to happen.
The president said Putin's nuclear saber-rattling is irresponsible, but we're prepared for whatever the Russians choose to do. In Washington, Irv Chapman, Bloomberg Radio.
The FDA is proposing a ban on the sale of menthol cigarettes, which make up about 37% of cigarettes sold last year. FDA Commissioner Robert Califf explains why the menthol flavor additive is being targeted.
Menthol's flavor and sensory effects make menthol cigarettes more appealing and easier for new tobacco users, like youth and young adults. It also interacts with nicotine in the brain to enhance nicotine's additive effects.
Commissioner Califf says they've also moved to ban all flavors, including menthol, in cigars. Both proposed rules need to be finalized after a public comment period. One tobacco manufacturer, Altria, says taking menthol products out of the legal marketplace will push them into unregulated criminal markets. Moderna is asking U.S. regulators to open its COVID-19 vaccine to the nation's youngest children. Kids under 5 are the only group in the country not yet eligible for vaccination. Moderna submitted data to the FDA today and hopes shots could start by summer. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy, thank you so much. Carol Massar, Tim Stenovic, live in our Interactive Brokers studio. Well, shares of Mattel, they shot up yesterday, their biggest gain in about 18 months, ending with about an 11% gain. They're up again today, 2%, following their latest earnings report. First quarter earnings last night that topped estimates thanks to Barbie and Hot Wheels sales that defy the usual seasonal slowdown. We are delighted to have back with us Mattel Chairman and CEO Ynon Kreiz via Zoom in California. Ynon, so nice to have you. How are you?
Great, Carol. Thank you for having me.
Well, it's wonderful to have you here. We are going to talk about the quarter, but you know where I'm going to go. We all kind of sat up a little straighter when that headline crossed that there could be a possible buyout, private equity interested. What can you tell us about that?
Well, as you'd expect, we don't comment on speculation, and we're focused on executing our strategy. What I can say is that this was the highest first quarter we have on record, both revenue and profitability. Our momentum continued across the business with double-digit growth in Barbie, Hot Wheels, and Fisher-Price. We have started the second quarter with strong consumer demand. The full-year outlook is also strong, and we expect to grow market share. So all in all, an excellent start of the year, and we're firmly in growth mode.
And I think we highlighted yesterday, I mean, you guys have been on a tear. If I look at, the share price in terms of the moves that you guys have been doing specifically. Some would say, and I'm going to push a little bit, that you are setting it up for a sale. Are you talking with people? Are there conversations going on?
Well, I can't comment on the speculation, but we've been consistently growing the company, and this has happened over the last 4 years. You follow the story, so you know that we took our adjusted EBITDA from $126 million in 2017 to over $1 billion in 2021, and guided for yet another growth this year with higher goals for 2023. So this is not a one-quarter situation. This has been consistent delivery and execution on a clear strategy and a clear roadmap. We're tracking well, and we are in a great position to continue to grow the company.
And I will point out that from the end of 2018, the stock is up almost 120%. So investors have certainly noticed that performance and those changes.
Ynon, one element that you've had to deal with, not just over the last year, but over the last few quarters too, are inflationary pressures on the supply chain. We've spoken to you and the company in past quarters about moves that you've made to try to make sure that your supply chain remains intact, what you've been able to do ahead of time, but it doesn't mean you've been immune to higher prices. Talk to us about the pricing power that you've had and how much you've had to raise prices and how consumers are being affected by that.
Yeah, given the anticipated inflation, implementing pricing action is one of the things we consider at times of inflationary pressures. We're not the only ones, and it's not unique to the toy industry. And this is something that we've done late in the second half of last year, and we expect to do that again in the second half of this year. It is important to say that when raising prices, we always keep the consumer in mind. And we're being very thoughtful and very strategic and remain committed to maintaining the right balance between quality and value for our consumers.
Well, you know, what's really great is, I mean, you guys have some old iconic brands. We've talked about it with you before, whether it's Barbie, whether it's Hot Wheels. I mean, it's just one brand after another. But then you have folded into the mix an embrace of all that is new through alliances and partnerships. What is it that really drives growth for you guys? What is it that you say, okay, this is top of mind, you know, in terms of the performance for the company overall?
Well, we've been growing on the toy side of the company very strongly. We expect further growth this year. We expect growth in the second quarter and growth for the full year. We expect our power brands to continue to grow this year, Barbie, Hot Wheels, and Fisher-Price, as well as American Girl. And we expect to see strong growth in the challenger categories. This is where we're not the global leader, but we're seeing tremendous momentum and growth in categories like action figures and building sets. So we are in a great position to grow in the toy side of the company. And in addition to that, we're also seeing great momentum on the IP strategy. This is film, television, content in general, consumer products, digital experiences. And this week alone, we had two very exciting news to share. One is that we partnered with J.J. Abrams to produce the Hot Wheels movie that we are developing with Warner Brothers. J.J. is one of the most prolific, respected producers of this generation. Filmmakers in general. Is also a director. And we're very excited to have him partner with us on Hot Wheels. And in addition, we also announced, or Warner Brothers announced at CinemaCon, the release date of the Barbie movie, which will be July 21st, 2023. And this film is shaping up really well to be an iconic cultural event. We could not be more excited with the creative execution and vision of Greta Gerwig, who is also one of the most respected and prolific creative filmmakers of this generation, and an all-star cast with Margot Robbie, Ryan Gosling, Will Ferrell, Simu Liu, America Ferrera, and many other very strong talent and exciting cast. So expect something very special from the Barbie movie, as well as Hot Wheels, and as well as other 12 films that we have in development.
Ynon, I want to go back to something that you said about challenger categories, areas where you're not actually the top of the category. Do you think you can become the leader of the pack in those categories? In action figures, for example, what will it take?
We're seeing tremendous growth and momentum. In the first quarter, we grew by 44% in the quarter, and this is on top of 66% in the same quarter last year. So we're lapping a very strong year with 44% in the first quarter. Within that, action figures actually grew by 75%. So huge momentum, driven by our own properties, such as Masters of the Universe, as well as third-party franchises that we manage on the toy side, such as Jurassic World, Minions, and Lightyear. Three big theatrical releases that are coming up in the second quarter and will further amplify our growth in this category, in addition to what we do already. So this is an area where we see an opportunity to position Mattel as a partner of choice for the major entertainment companies and owners of big, important franchises to leverage our platform, our capabilities on the design side, supply chain, and commercial execution, and really grow these franchises and manage them as evergreen properties that are not just dependent on a movie launch, but this is where we can bring our capabilities and manage franchises as evergreen IP and continue to create value for our partners.
Well, I think about what you said about IP strategy, film, TV. You guys are already doing it with the Barbie movie. You're going to do it, as you said, with Hot Wheels. And I do think about what's the best way for you to leverage all of that? Is it by doing it as a standalone and just partnering and creating alliances with media and entertainment companies, or is there some kind of, going back to our first question, some kind of more significant link up with a specific media house, Disney for the matter, that would make sense and really create some incredible leverage?
Well, our approach has been capital light, in that we don't take capital risk in investing in movies. And that capital light approach applies also to our manufacturing strategy. What we do on the content side is we partner with the best in their respective fields. So we partner with the best distributor as a major studio, and the best creative talent per genre, per project. And that gives us the ability to do that at scale and develop multiple projects at the same time and not be limited to one or two movies coming out every 1 or 2 or 3 years. So we can do it at scale, work with the best people per genre, per opportunity across the industry, and have multiple shots on goal with incredible brands and incredible franchises, and still find the right economic balance in terms of risk and reward for Mattel, where our currency, our contribution is the IP, the franchises that we know, our expertise and know-how of those franchises, and making sure that we collaborate and bring our understanding and the nuanced knowledge of these franchises to the table and create something very exciting for consumers all over the world.
All right, and I'm a little persistent, as you might know, we talked a few times. So you are firing on all cylinders. Mattel is firing on all cylinders, and you guys have had 3 consecutive years of dynamic, certainly equity growth, and like I said, investors are noticing. So some would say that is a reason, the top perhaps, or at a prime moment, to sell the company. Others would say it's, you are talking about more avenues for growth. What would it take to do a deal that makes sense? Obviously, shareholders of the board have to agree, but, is it just about price or is it about strategy?
Well, we're here to create shareholder value. We've been very consistent about executing our strategy and always have our shareholders' interest as a North Star. We have been doing it consistently. We see a lot of runway for the company to continue to grow and to create more shareholder value. And that's our job. That's our focus. That's what we've been doing. And this is what we are looking to do going forward.
Ynon, give us a time frame for the strategy here. I mean, when you think going forward, what does that mean to you? How many years? How many quarters?
Well, the original strategy that we set out was to grow the toy business and in the mid to long term, execute on our IP strategy. Now, further down the road, we're now looking to continue to grow our IP toy business, IP-driven toy business, and expand our entertainment offering. We have put the building blocks in place for the second part of the strategy, and you're now starting to see the fruit of that work, with a release date for the Barbie movie as a first, and more to follow, more to come. We will release on the television side, on the episodic side, we will have 13 series and specials on air in 2022, 9 of which are new and 4 are returning. This is a full slate. This is a real offering that will continue to grow and evolve.
So, Ynon, to help our investor audience understand how much Barbie sales will increase when the movie comes out. How much Hot Wheels sales will increase when the movie comes out?
We haven't outlined that specifically by brand, and it's not something that we typically break down at that level. But we all understand that a content strategy, an IP strategy, increasing the touch points and the engagement of consumers with our brands at multiple levels is a good thing. Our approach on the content side, on all of our experiences outside of the toy aisle, was to create quality experiences, quality content that will engage consumers. So when we develop a movie, the approach is not how are we going to sell more toys on the back of this movie. The approach is how are we going to make the best movie that people want to watch.
We know
if you do that well, good things will happen.
We know you have to run. 30 seconds left here. The Barbie movie, have you been on set, seen some of the filming?
I have been on set, and I can only say it's extremely exciting. The quality, the visuals, the execution is stunning. And I came back super excited, and I know it's going to be very special.
All right, well, we're looking forward to it and always appreciate when you find time for us. Ynon Kreiz, he's Chairman and Chief Executive Officer of Mattel. That Barbie movie in theaters July 21st, 2023. And I really appreciated getting some time with us. So much going on. That stock, though, and that company has really been on a tear. You're listening to Bloomberg Business Week on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. Carol Massler, Tim Stenovic. It's been a big week for big tech earnings. We've heard from a lot, but we've got more coming. Amazon, Apple, Intel after the closing bell. We've got such a great guest who's going to be with us for the next half hour. We're going to talk to him about what we've heard so far and what's to come.
Yeah, James Chalkmock from Clockwise Capital is going to be joining us in just a minute. And don't forget Roku, Carol. That's one of my favorite companies to cover.
Roku as well.
Yeah, down 80% from its July highs last year.
That's messy.
It is messy.
All right, we'll get to that in just a moment. First up, back to the markets and a look at your top business stories. Charlie, we're just rolling over off our highs.
Indeed, but still holding very close to it. Listen, let's take a look at some of those big tech names. Tim talking about Roku, up right now by 8.2%. We heard from Qualcomm last night, up 10%. Facebook, the standout, up now by 18% on Facebook after the bell. We will be hearing from Apple, shares advancing by 4.6%. Amazon up by 5%. Got to keep it locked into Bloomberg Radio as we take apart those numbers. Our coverage will continue. And, of course, what implications are there for Asian markets tonight? Daybreak Asia will have you covered on that as well. Here's where we stand right now with the S&P up 113, up 2.7%. We've got the Dow up 680, again, very close to session highs, as Carol mentioned, up right now by about 2%. NASDAQ up 417, up now by 3.3%. Your 10-year yield on this Thursday, 2.84%. Gold up 0.5, $18.95 the ounce, while West Texas Intermediate crude rallying 3.2%, 105.26. Stocks rallying the most in 7 weeks as strong earnings from tech heavyweights bolsters optimism that corporate profits can withstand an aggressively restrictive Federal Reserve. Moderna has applied for emergency use authorization for its COVID-19 vaccine in children from 6 months to under 6 years old after a successful trial showed 2 doses generate high levels of antibodies to the virus. While the vaccine from partners Pfizer and BioNTech is authorized for kids 5 and up in the U.S., there is no COVID vaccine for those under 5. Dr. Chris Beyer is a professor of epidemiology at the Johns Hopkins Bloomberg School of Public Health. He says if you are vaccinated, the U.S. case count numbers are improving.
We can't say if there will be another variant from another lineage or if we have a worsening variant with Omicron. It's too soon to know that. But with what's circulating now, that's the trend we're on. That's why Dr. Fauci earlier this week said we're out of the pandemic phase.
And that's Dr. Beyer with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Among some of the vaccine names, right now we have got Pfizer up 1.5%. Its German partner BioNTech down 1.5%. AstraZeneca's ADR is up 1.2%. Moderna down 0.5. Johnson & Johnson higher by 1%. Recapping tech earnings just around the corner. Apple now up by 4.4%. Amazon up by 4.9%. And that's a Bloomberg Business Flash.
All right, Charlie, thank you so much. You guys know, right? You've been listening to us, watching on YouTube. We have been all over so many big tech earnings. Netflix, of course, we've heard from Meta, we heard from Pinterest, we heard from Google, we heard from Alphabet, of course. Who am I leaving out?
I don't know. This is the biggest week. This is our quarterly, Super Bowl.
Yeah, exactly. The tech Super Bowl. Hey, James Chalkmock, I don't even know if he's been getting sleep. Partner and technology analyst at the asset management firm Clockwise Capital. He is back with us.
He's fine. He
in
lives
Miami.
in Miami. They just hang out. It's not like Wall Street, okay?
You living in Margaritaville? Is that what's going on?
Good afternoon, guys. How are you?
Oh, sorry. You're just very serious. Very serious.
All right. So talk to us about what we've gotten so far. Netflix. Can we go back to Netflix? I'm curious your takeaway on all of that and what it means going forward.
Sure. I'd say 2 kind of big takeaways from Netflix is that, one, you have this subscription saturation in the market. Clearly, we've been a rising tides lifts all boats situation for quite some time as it relates to services and cord cutting and video offerings from different players. But as competition has increased and attention time spent has remained finite, you are reaching a point of saturation. So investors are essentially trying to decipher who's going to end up maintaining the most sustainable growth in this next chapter. Netflix obviously has a big question mark on it. But I'd say if you zoom out just a little bit, the overarching theme for Netflix and tech more broadly is this concept of mean reversion. And what we mean by that is that, you had these growth curves across technology that have been largely predictable prior to COVID. And what happened was COVID pulled forward a tremendous amount of demand for these companies. So you saw growth accelerate well beyond what investors had expected for the companies over the next 5 to 10 year cycles. And then what happened today, over the last quarter and this quarter and likely into next, is that the growth rates have been decelerating tremendously because you're lapping these huge growth numbers from last year. So really, when we think about the risk associated with the market and the drawdowns that we've seen, we think it's less about the Fed, inflation, rate hikes, and so forth, and more about investors having a tremendous amount of difficulty ascertaining exactly where these growth rates will land for these companies on a normalized basis. Our investors are thinking, are these new lower growth rates the new normal, or will they revert back to the way things were?
I mean, some of these,
you can make the case. Yeah, go ahead.
Yeah, James, some of these companies have are just beat up. I mean, Netflix down 71% from its highs back in November. You have companies like, until today, Meta shed 50% of its value just this year. Roku down 80% since July of last year. PayPal just getting absolutely crushed. Are these stocks oversold? Are there buying opportunities here?
Yeah, I mean, I think through that mean reversion framework, you can kind of come up with high degrees of confidence on which ones are going to be the winners and losers. You look at a company like Microsoft, right? This is a company where the world completely moved in Microsoft's favor because of COVID, which means that the growth rate is actually, the sustainable growth rate is higher than we had expected prior to COVID. So that's one that's benefiting. The world moved somewhat against Google's favor as competition increased and attention spans moved into other areas. And that one is likely lower than expected. Facebook, even more so lower than what we previously expected, which is why the stock is down tremendously. And Netflix is also tremendously lower, which is why the stock is also down. But I think you can decipher Amazon is going to be a huge, huge comeback. I mean, it's our number one position, and it's probably the number one most undervalued company in the market right now.
Wow.
And the company that provides the most value for your subscription than any other service in the market combined.
James, hang on for a second. We're going to do a little bit of news, and then we'll come back and continue with you. I want to explore a little bit more on what you said on Amazon. Right now, back to Nancy Lyons in D.C. Hey, Nance.
Thanks, Carol. Saying the U.S. needs to help Ukraine in its fight for freedom, President Biden is asking Congress to provide the country with another $33 billion for military, economic, and humanitarian aid.
We need to contribute arms, funding, ammunition, and the economic support to make their courage and sacrifice have purpose so they can continue this fight and do what they're doing.
Biden says this aid needs to be approved quickly before the conflict becomes more costly. He wants the aid designated as emergency spending that does not need to be offset by spending cuts elsewhere. Well, the White House is making some progress on a global campaign to promote freedom of expression online. Bloomberg's Nathan Hager has that story.
White House National Security Advisor Jake Sullivan says Ukraine, Israel, and Taiwan are among more than 50 nations getting behind a pledge to support the internet as a platform for transparency and innovation. This initiative may have gotten a boost recently after Russia's internet crackdown during the war in Ukraine, but it is still falling short of U.S. ambitions. Officials say the initiative is a declaration rather than an alliance. Several countries haven't signed on to it either, including India, the world's biggest democracy. In Washington, I'm Nathan Hager, Bloomberg Radio.
New York City is postponing enforcement of salary transparency until November. Officials took the action after advocates and business leaders clashed on whether pay disclosure is the best way to close a persistent gender gap. The city council has also moved to exempt companies from being charged a monetary fine for the first violation. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Masser, along with Tim Stanovic. Obviously, we are focused on a slew of big tech earnings coming out after the closing bell. Intel, Apple, Amazon among them, but there are many more. We're going to get back to James Chakmak over at Clockwise Capital in just a moment. In the meantime, a little heads up of something this weekend.
Yeah, you and I are both getting on planes.
No, we're not. Oh, we are.
We are, but we're not going to Omaha.
No, we
okay?
are not.
Warren Buffett, the deal maker, is back. After hanging in the shadows for most of the pandemic, the billionaire investor and his deputies, they've been ramping up Berkshire Hathaway's acquisition machine. We've talked about it a lot. They bought shares of Occidental Petroleum, HP Inc. They struck an $11.6 billion deal to buy Allegheny. The flurry of activity, though, Carol, coming just as investors are set to flock to Omaha, Nebraska for the conglomerate's first in-person shareholder meeting since 2019.
Big deal. This year's Omaha event on April 30th marks the return of the famous Woodstock for Capitalists that distinguishes Berkshire's gatherings from pretty much most other companies' annual meetings. The day typically a showcase for Berkshire's many holdings. There are booths handing out See's candies, which are a favorite of mine. Whenever I'm on the West Coast, I buy them. Toy trains mimicking...
They don't have those here?
Not as easily.
Wow. I mean, it's a thing we grew up with in California, but I never knew they were so regional.
I don't know that I ever find them as easily, except when I'm like definitely on the West Coast. They're always in the airports, and I'm like, I got to buy the nut clusters.
Well, maybe some investors this weekend will ask about potentially increasing distribution of See's candies.
I mean, maybe there's places. Do you ever see them over here?
I don't ever see them here. They were such a part of my childhood in California.
Toffee. Oh,
yeah,
so
you're right.
good.
Brooks Running Shoes.
Brooks Running Shoes. We talked to Mr. Weber,
the company's CEO, Jim Weber.
New book out. Really love that. There's also toy trains mimicking Berkshire's Hathaway railroad holdings, and there's hours of commentary from Buffett, 91 now, and his longtime business partner Charlie Munger, 98, and two key deputies, Greg Abel and Ajit Jain. I mean, it's a party. There's a lot going on, but it's always closely watched. I know our Kat Chiklinski will be there.
Yeah. Oh, that's pretty cool. I didn't know she's going.
I think she's going, yeah.
Oh, that's cool.
I
Well,
said
hopefully
it
we
so
can catch up with her
definitively, but
ahead
I'm
of
pretty
that.
sure she's going.
All
She
right.
and I were talking
Well,
about
maybe
it.
she'll bring you some See's candies.
Yeah.
Or maybe you can get some in California next
Carnival,
week when you're there.
Right? Carvel? Doesn't he still own Carvel?
I don't know.
All right. Anyway, this is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We are minutes away from the latest quarterly numbers out of Apple and Amazon. Apple shares up now by 4.4%. We have got Amazon shares advancing by 4.7%. We're off session highs, but still, the Dow, the S&P, and NASDAQ all rallying. Right now, we have got the S&P up by 103 points. That is a gain of about 2.5%. If you're keeping track, and yes, we are here at Bloomberg, stocks rallying the most in 6 weeks. Strong earnings from tech heavyweights, bolstering optimism that corporate profits can withstand an aggressively restrictive Federal Reserve. 10-year yield right now, 2.84%. The Dow off session highs up 598, now up by 1.8%. NASDAQ is advancing 3%. The NASDAQ 100 index right now climbing by 3.5%. Among today's earnings standout, Meta Platforms shares up by 17.8%. That, of course, the parent of Facebook. Again, recapping, gold up 0.5%, $18.94 the ounce. S&P up now by 2.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
Congress is moving closer toward imposing new restrictions on billions of dollars in outbound investments. Unfortunately, the rules could overwhelm regulators and entangle U.S. companies in red tape. The issue is coming to a head now, as House and Senate negotiators prepare to reconcile two massive bills aimed at improving U.S. competitiveness against China. One proposal in the House bill would create a committee scrutinizing investments that might increase dependence on China for critical goods and services. But it's far too broadly written. Countless harmless transactions could fall under its remit. Once more, the required review process would be easy to politicize. It would also put U.S. companies at a disadvantage to competitors facing less burdensome regulations. The U.S. isn't wrong to worry about emerging vulnerabilities, but rules like these would create more problems than they solve. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
All right, of course, Bloomberg Opinion there. We want to get back to James Chakmak. I just want to point out, I mentioned Warren Buffett. It wasn't Carvel, it's Dairy Queen that he bought a few years ago.
I would still take one of those right now.
I would. All right, James Chakmak is with us, partner and technology analyst at the asset management firm Clockwise Capital. You said, just before we went to the break, Amazon's your number one position, number one most undervalued company. Explore that a little bit further with us.
I mean, sure. Think about what you get with your Prime subscription for $140 a year. You get 6 businesses in one when you buy a stock share of Amazon. You get retail, logistics, video, music, grocery, and the cloud. And you're getting it at 3 times sales. And when we talk about the mean reversion, this is a company that grew 9% last quarter, but used to grow about 20% revenue every quarter like clockwork. I think by the time they report third quarter guidance, in 3 months' time, you're going to see the growth rate double back up to 20%. And the shares either this quarter, beginning next, are just going to rocket off where we are. It's trading at 3 times sales compared to Chipotle at 6 times sales. So you're getting Amazon for half the multiple as a burrito.
James, where are you going to see that? Where are you going to see that growth? Are you in Amazon? Are you going to see it in AWS? Are you going to see it in retail?
Advertising is going to be huge. Advertising is going to be a huge driver. I think that's part of the reason you're seeing the pains at Facebook and to some extent YouTube.
Our Bloomberg Intelligence team wrote the same thing, James. They're kind of on the same thinking of you that there's a lot more marketplaces, including Amazon, that's eating away at some of the advertising budget that has been enjoyed by, a few for a long time, but no more.
I completely agree. I mean, I think it's going to be, and it's so nascent relative to its other businesses. I mean, it's going to be growing in 30-40% range, likely for the foreseeable future. Obviously, you have the membership component to it, and the cloud, as reinforced by Microsoft and Google's results. will be growing at very, very healthy rates as well. And retail growth rates will normalize back to pre-COVID levels. So this one to me is the biggest no-brainer of the bunch when it comes to big tech.
What should we be looking for with Amazon earnings in just a few minutes when they cross?
The main thing I think is that you're going to see better discretion on the expense side. So I think that's going to be an area of surprise, and obviously a steeper profitability growth curve as a result of that. But most importantly, the fact that the growth rate is moving back up for that 20% number that we used to have prior to COVID. And once that happens, because they'll fully be lapping things in the second quarter. So I think we're just, days away from seeing those kind of numbers from them.
If they don't see that kind of positivity, is that a little bit of a disappointment to you then?
I mean, in our minds, it has always been when they report 2Q and provide that third quarter guidance in 3 months' time. So I can't say with great certainty that it's this quarter, but I certainly think that the trends will be in that direction this quarter, and at the very least, they'll discuss it that it's in that trend on the earnings call.
How important is advertising to Amazon? And I'd say this, in quotes, it's a relatively new business to the company.
Yeah, I think it's important. I think it just shows that it's a proof point that people go to Amazon first. It's a
right. They're not necessarily Googling the product. They're going to Amazon and they're using the search there to do it.
Yeah, and the proof is in the pudding. So if the dollars are moving in that direction, it clearly means that behavior, consumer behavior, has moved in that direction, and it's not going anywhere. So the one thing I just wanted to add before we go is that the number one mistake investors make is they tend to underestimate the sustainability of the growth for these cloud-first companies, and it's been done throughout time. The number one example I always think of is Walmart. Walmart from 1969 to 1999 grew 36% year on average for 30 years. I mean, how many people would have thought in 1969 that Walmart's a company that can average over 30% growth a year?
Right.
For 30 years. Virtually impossible. But it saved people a lot of time because they had the superstores. I think the cloud-first companies of today, the Snowflakes of the world, the CrowdStrikes, Twilios, Airbnbs, Okta, Amazon, these are companies that can have much, much more sustainable growth rates than people expect. So I think we are in one of the biggest buying opportunities of at least my investing career, and right at this juncture, and I would say much more so even during the depths of COVID. So right now, it's tough out there, but if you can pick the right horses, there's a ton of money to be made, and the analogy is you're buying Walmart in 1969.
So all right, so someone's got new money that they want to commit. They're a little freaked out by some of the volatility. So what are 5 names that you would say, this is where you should commit new money? You might need to be patient. It might be a little bit of a crazy ride, but this is where you should go because it is the Walmart, like you just said,
sure.
of past.
I'm in Amazon, number one. I definitely do Snowflake. I would definitely want to play a security type name. Cybersecurity is going to be critical. That would be a company like CrowdStrike. I like, let's see, I still do like, I like Tesla here, especially after the pullback here. I think this is one that.
Go ahead.
Tesla is changing the world. And the advantage that they have in production, they are miles ahead, and it's going to take years and years for others to catch up on the cost effectiveness and efficiencies that they can gain over time at Tesla. So that's one definitely. And NVIDIA, I also add NVIDIA because they're involved in everything that's involved in the future.
All right, really quickly, 20 seconds. So Tesla, even with a buy of Twitter, you think it's okay?
Yes, I think it's okay. It's noise. It's noise right now.
It's a lot of expensive noise,
and the thing is, honestly, they say that Musk doesn't care about monetization, But if you do the things that he says he's going to do at Twitter, I really think that the monetization potential is far bigger for Twitter than it's ever been. So I think, yes.
Well,
no question.
What a treat for us to be able to do a double dive with you. So thank you so much. James Chakmak, he's partner and technology analyst at the asset management firm Clockwise Capital, joining us once again on the phone in Miami. We say goodbye to him with just about 3.5 minutes left in today's trading session, rolling over on those equity averages, but just a little bit. So we're just off our lows, but still almost a 3% gain on the NASDAQ, 2.4% higher on the S&P 500. And we are getting ready for some big, big earnings. Coming up next, we'll be joined by our TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We are counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Taylor Riggs, Katie Greifeld in for Caroline Hyde. We're counting you down to the closing bell, and here to help take us beyond the bell. It's our global simulcast with Carol Masser and Tim Stenovic. We welcome our audiences across Bloomberg Television and radio, as well as on YouTube. And Carol, the massive rally that we talked about a little bit of an hour ago with you, well, it's still intact here. The S&P up more than 2%, the NASDAQ up 3%.
Yeah, just rolling over our highs, but nonetheless, as you said, holding onto their gains. And pick apart some of the sectors. I mentioned the stocks earlier. Those chip names, thanks to Qualcomm, up about 5.5% as a group. Home builders also charging ahead, Tim. They're up about 4% today. So beating the overall market.
Yeah, for the NASDAQ.
Homes?
What?
Are people still buying homes?
Apparently. Although there's a great story in the Bloomberg about Mr. Kissel over at PIMCO, right? Who called some of the tops
Mark
before.
Kiesel? I thought this was a great story.
Yeah.
Is he going to really sell his home again?
I don't know, but he called the top before. All right, we digress. Tim, what do you got?
I was just going to say the NASDAQ 100 is, right now having its best day in more than a month. So we are seeing a difference in sentiment.
Wow.
Yeah.
Well, and you're
Is that
seeing,
not long enough for you, Romaine?
You're seeing at least a little bit of a
Do you have
some
coffee or
stability within the yield market. Perhaps maybe that's providing a relief here. It's actually finally a day, Katie, when we're not getting 10%, 10 basis point moves, of course, on a 2-year yield. Only about 3 to 4, and some big stability, of course, on the longer end as well, on the 20s and the 30s.
Yeah, instead it seems like all the action is in the FX market. I mean, we've spent so much time talking about currencies just today, and a 10% move on the Japanese yen against the dollar in the past month. That doesn't often happen in the currency market.
All right, a lot of earnings about to hit the wire shortly here, so let's get you through the numbers real quickly. Dow Jones Industrial Average going to finish the day higher by more than 600 points, roughly 1.8% as we wait for these numbers to settle. The S&P up about 103 points or 2.5%. The NASDAQ Composite is going to finish the day higher by more than 380 points or 3% on the day. Russell 2000 not to be left out here on the day, finishing higher by about 34 points or 1.8%. Intel earnings crossing the wire right now. We're taking a look at those earnings coming in right now on an adjusted revenue basis for the first quarter, $18.4 billion. The street was looking for $18.3 billion, so a slight beat on that. As far as EPS, the number coming in at 87 cents a share. The street was looking for 80 cents a share. That's a beat, and the company reaffirming its full-year guidance for 2022. Shares slightly higher here or in the after-hours trading.
And really fascinating when you think about the huge moves that we just saw in Qualcomm as well, the big chip makers. Some of that at least trying to extend a little bit to Intel with that forward guidance. But of course, Carol, still off about 3% or so in those after hours. The market will bump around until it finds some stability.
Well, what we've been wondering, right? This is a company that benefited by all the PC demand during the, work from home, the pandemic plays. So we're curious about whether or not that's having an impact. I do think it's interesting and important that they are reaffirming their 2022 revenue guidance, as Romaine mentioned.
I have Amazon, Carol, so I'm going to get to it. Taking a look at first quarter net sales, $116.4 billion, slightly on the line of $116.43 billion that was expected. Looking forward, looking at second quarter net sales as well of about $116 to $121 billion. That's a little bit light. Analysts were looking for expectations about $125 billion. So really looking at some light numbers on second quarter net sales remain that go forward. Let me get to some of the AWS numbers. First quarter AWS net sales, again, big improvement here in the cloud, $18.4 billion versus estimates of $18.2 billion. And of course, Amazon coming out and is saying that really here, second quarter operating loss to a profit, and help me through this, negative, a loss of $1 billion to a profit of $3 billion versus estimates of a profit of $6.8 billion. So that actually could be a big downside number when you look at second quarter, looking at a loss to a profit instead of big profit numbers being big declines here in some of the quarterly results after hours.
This is interesting commentary out of Amazon too. When you start digging through the release, they still talk about some of the inflationary pressures out there. But I thought this was interesting. They say they're no longer chasing physical or staffing capacity anymore. They say they're now squarely focused on improving productivity and cost efficiencies throughout our fulfillment network here. So I guess you can kind of read in between the lines and figure out what they're talking about there. But obviously a company, still $100+ billion revenue company in a single quarter, but in one that's certainly facing some challenges going ahead.
So that first quarter operating income, $3.7 billion versus estimates of $5.4, and affecting that first quarter operating margins, 3.2% versus estimates of 4.7%. Let's do all of this with Poonam Goyal, our senior U.S. retail analyst here for Bloomberg Intelligence. And Poonam, we've given you a cool 5 seconds to digest the numbers. What really stands out to you?
I think two things. One, AWS continues its pace, so that's great to hear. On the online business, clearly in line with expectations, but the margin, as you talked about it, weak. You could say that that's surprising, but it's really not. I mean, from everything that we've been seeing all year, the supply chain crunch is only getting worse. It's not getting better. So they are getting hit from higher costs across the board. And that's what we're seeing in the guidance now.
Got to say, when I order things from Amazon, there are delays. Like, there are things that don't come like they used to. And we certainly see problems personally, anecdotally. What's interesting, though, then, Poonam, do we just say, we look at Amazon, even though it's down about 10% here in the after hours, do we say, okay, I get it. It's a supply chain problem. It's a very specific problem. Amazon, once things get better, will work it through. Or is there something else that we need to be concerned about here?
For the online business, the supply chain problem isn't going away anytime soon. It's not. But I'd say for Amazon, they have other things that are working very well for them. And these are businesses that are highly profitable, whether that's AWS or whether that's advertising. Those businesses are high margin business, over 50% on the advertising front. And we think that's where they can offset some of these pains that they're experiencing in retail over time.
They talk a lot in this press release, I think for the first time that I've seen with this type of breadth about their employee base and what they're doing, I guess, to, quote, invest in their employees in our workplace. We know, Poonam, that labor issues have been a big issue for Amazon now for the last couple of years. I'm wondering if you worry at all that it could actually have a financial drag on the company rather than just whatever public relations drag it might be having.
Yeah, look, I think Amazon pays decent wages to its employees. So on that front, they're protected. In terms of unionization and what we've seen come across at one of the warehouses, will that expand? Will that not expand? It's yet to be seen. Would the employees love to have a union? Yes. But does it hurt Amazon in terms of higher costs over time? Sure, absolutely.
But Poonam, to that point, they do have high turnover at these fulfillment centers. And there have been concerns in the past of them just essentially running out of employees. And I'm wondering if they're going to have to raise wages to the extent in order to attract and retain talent and keep increasing benefits in order to keep employees there.
Yeah, I mean, wages are definitely going to play a part in keeping employees there, but also productivity, right? What they talked about in the release from what you said earlier. Is each employee actually operating to their best productivity? And is there a way to improve that with added technology enablers? And if they can do that, that they can boost productivity, and perhaps they need to look at incentivizing employees, not just with wages, but maybe with more holidays, more paid leave, et cetera, progression in their career. Those are things that are important to employees today and that employers need to keep an eye out for.
And this is turning into a real wipeout after hours. You can see Amazon shares down almost 8% at this point. Poonam, with that sort of setup, I mean, what would you want to hear from company executives? What could turn around this stock after hours?
I think they have to focus on their higher margin businesses. The stock is down largely because of the profit guidance. I mean, losing money, once again, even after having AWS contribute about 75 to 80% of their profits is a big deal. So where can they offset these rising costs? Is there potential to offset them? How soon can we offset them? Those are the things that we'd want to hear.
All right, we are talking with Poonam Goyal, of course, of Bloomberg Intelligence, breaking down those Amazon earnings. Do you want to mention Robinhood, because they also came out with their results. First quarter net revenue, that's a miss, $299 million versus an estimate way above that of $352.9 million. Monthly active users, that's also a miss. They're do say they are on track with their 2022 roadmap, which begs the question, what exactly is that, considering this week they've already talked about cutting, 9% of their workforce, and they no longer intend to provide revenue guidance. And the stock, if we take a look, it is definitely selling off here in the after hours, down about 6% here. Poonam, let's go back to Amazon. It's such a big company, such a big part of so many of our lives here. So what is it that maybe we need to see coming off of this earnings and maybe some of the investor concern in months to come here?
We need to hear them say that they found a way to lower costs. And I don't know if they can do that just yet. So that's going to be the biggest challenge ahead of them. They've invested a lot of money in logistics and transportation, but when will that actually pay off?
You talk about lowering costs. I mean, they just closed this deal for MGM. I mean, there are a lot of people that kind of scratch their head as to why they even have a streaming service to begin with. Is there a payoff that they get out of that streaming service, a tangible one that you can see that justifies some of the costs that they spend on it?
I think over time, yes. I mean, these businesses, once again, if you're comparing Amazon's traditional retail business to any of the new businesses that they're investing in, whether AWS, whether streaming, or whether cloud, these are much higher profit businesses. So for them going after these higher profit businesses is going to help the operating profit line over time as they scale.
There was some conversation, and correct me if I'm wrong, hints of could you separate out AWS from the traditional sort of e-commerce side? And the answer was always no, no, no. The two work together to offset some of the losses. After this, do you rethink the way you start to ask those questions again?
No, I don't. I think that Amazon's best interest is to keep the businesses together, because online by itself, the profits would, be slammed essentially.
It's in Amazon's best interest. Would shareholders go along with that?
I mean, look, shareholders would argue a breakup of any big company, right, to monetize their assets, but I think overall the bigger picture is still that these investments that they're making in these higher margin businesses will pay off. It's just a matter of time and scale.
Yeah, I mean, we certainly know some lawmakers would like to see that, Poonam. Another headline that we're getting, Amazon guidance is assuming that Prime Day occurs in the third quarter of 2022. How important is Prime Day in this day and age when it seems like, I don't know, every day is Prime Day if you're a Prime customer?
Prime Day is important. I mean, today's Way Day, right, for Wayfair. So it's just one of those days where you get the customers excited about getting deals. And third quarter is important because it's right ahead of the holiday shopping season. So they had moved it from 2Q to 3Q a few years back. And essentially what they're doing is taking the spend earlier, right? So if you're spending on holiday, typically in October, November, or really November, now you're spending it in October. And that helps.
Just to be clear, you said Way Day? That's what Wayfair has? That's like their version of Prime Day?
Yes, absolutely. Okay. And that's happening today.
All right. I did not know that.
Way to get on board.
I do want to point out that if you look at the QQQ after hours, that tracks the NASDAQ 100, down 1.2% at the moment, really just speaks to how big a company Amazon is, how important it is. And Poonam, we are hearing from Amazon CEO Andy Jassy that the company is focused on improving efficiencies in its warehouse and its delivery network. I'm curious, when it comes to cutting costs, do you think that's the right focus?
I think it's more about improving efficiencies. So where they're investing and where they're looking to enable technology to help make it more efficient is going to be important. And where the costs are rising is primarily in the logistics infrastructure area.
What do you mean, again, sort of by that big quote from Andy Jassy, where we're no longer chasing physical or staffing capacities? Does that mean no longer chasing up this labor market and the wage gains that come with it? Or is it physical capacity of the stores? What does that quote tell you?
I would read it more as chasing the physical labor capacity. So they're trying to do more with less, right? And the only way to really do that is to make your processes more efficient. Use technology to help you drive better productivity. Because online sales volume is still growing or will grow at a double-digit clip. So you do need to be able to process these extra orders that you're getting, and either you do it with more humans or you do it with more technology.
I have a question about some of the, a real tiny part of their business, which is some of the physical stores that they've pursued, the Amazon Go stores and some of the bookstores. How committed are they to this idea of needing a physical retail presence?
I think they're testing and playing with the space. It's very, very small. They're playing with it. It's interesting. You know, they've taken away some of the tests that they've done in some of the smaller stores, but the Amazon Go store remains. And we'll wait and see what happens, but it's not something that we see them scaling in the next year in a big way where it will actually be needle moving.
They're still going through with the stock split though, right?
Yes, that is happening.
20 for 1.
Yep, that is happening June 6th, I believe.
Hey, Poonam, our Spencer Soper on our MLive blog talking about worldwide shipping costs jumping 14%, almost $20 billion. Meantime, revenue from online store sales dropping 3%, revenue from third-party sellers increasing about 9%. He writes, inflation exposing the dangers of Amazon's low-margin e-commerce model. Like, I don't know, I sit at home and sometimes I'm like, how the heck do they make money when they're delivering me, one little item every day and I'm a Prime member? I mean, does this model still work? Does it work in that it puts us into this Amazon infrastructure?
That's what they're trying to fix, right? That's what he exactly said. He said, let's make it more efficient. I order something from Amazon, 5 items, I get 5 different shipments. That's not practical, and that's not going to make them money. So how do they put that together and send it in one box? They need to become more efficient in the way that they process orders, because to your point, costs are up double digits, and they need to find a way to offset that. In the past, it was okay to ship 5 shipments because it wasn't that expensive, but today it's become even more expensive.
Is it that they don't care or they just can't do it? Because even when you check that box that says, I'll take everything in one shipment if I want to wait a few extra days, it still shows up in 5 different packages.
Right.
To just later in the
I
week.
never check that box.
Well, I've learned my lesson now. It doesn't matter.
I always check that box, and I think that's where they need to become more efficient. That just shows you the gaps, right? The low-hanging fruit that they have that they can easily fix to drive some of those margin gains.
Really appreciate it. Poonam Goyal, of course, senior U.S. retail analyst here for Bloomberg Intelligence, going to be sticking with us again up until 5 o'clock. Carol, big news out of Amazon.
Yeah, absolutely. Looking at the stock down more than almost 10% in the after hours. Intel's down about 4%, and we've got Robinhood down almost 8%, and we're getting ready for those Apple results. All right, guys, we got to run. That's going to do it for our cross-platform coverage on radio, TV, and YouTube. Beyond the Bell. We'll see you again, same time, same place tomorrow.
You're listening to Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Carol Massar and Tim Stenovic live in the Bloomberg Interactive Brokers studio in New York. Carol, Roku earnings crossing and the company net revenue for the second quarter missing estimates. The stock kind of bouncing around between positive and negative territory. We're going to keep digging into them. Investors not really making up their minds after hours.
And of course, we're waiting for our Apple. In the meantime, let's get a check on your top business story. A lot of earnings, Charlie, after the closing.
Indeed. Let us focus, though, on Amazon right now, projecting that second quarter loss. Inflation bites, shares tumbling. Its sales forecast misses estimates. Amazon sees second quarter net sales in the range of 116 to 121 billion. Estimates have been for 125.01. After hours, Amazon shares down now by just about 9%. Poonam Goyal is a senior analyst with Bloomberg Intelligence. She was interviewed moments ago right here on Bloomberg Business Week.
I think they have to focus on their higher margin businesses. The stock is down largely because of the profit guidance. I mean, losing money once again, even after having AWS contribute about 75 to 80% of their profits is a big deal.
And indeed, stock moving lower. That a big deal, down now by roughly 9%. Also reporting moments ago as we await Apple, Intel, the world's biggest maker of computer processors, delivered a disappointing sales and profit forecast. Investors sending Intel shares lower now by 4.3%. Equities higher across the board, though, as traders embrace the strength of corporate earnings and evidence of solid consumer demand masked by the surprise contraction in economic growth last quarter. S&P 500 index up today by 103 points, a gain of 2.5%. Dow Industrials up 614, up 1.9%. Nasdaq up 382, higher by 3.1%. 10-year yield 2.8%. We do have a spot gold up 0.5%, 18.95 the ounce. West Texas Intermediate crude up today by 3.2%, 105.31 a barrel. We're on Apple Watch. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
We are indeed, Charlie. Thank you so much. Right now, though, we're watching shares of Amazon in the after hours, as Charlie mentioned, selling off, pretty much hovering near its lows in the aftermarket, down about 10% here, following some disappointment about some of the metrics from the last quarter and also about the projections for the second quarter when it comes to revenues. So let's continue with our deep dive into tech on this Thursday. With us right now is John Ehrlichman,
co-host of Bloomberg Markets on Bloomberg Television, also a correspondent for CTV National News. John joining us us on the phone from Toronto. John, you've had about 15 minutes to dig into these first quarter earnings for Amazon. Some of the highlights do include that the company is seeing a significant hit from inflation, perhaps not too surprising, but in after-hours trading, shares down about 10%. What sticks out to you?
I think just that for a company that had, Tim, for so many years focused on growing the top line at the expense of the bottom line, that today you have a couple of complicated parts there. First of all, it does seem clear that with all of these higher costs that you and Carol talk about every day, that just about everyone is dealing with right now, that there is a certain reluctance on the part of Amazon, which is so customer first, to pass on all the costs that they are dealing with, like so many companies, onto the net customer. And so that makes sense on some levels. You know, if Andy Jassy, the new CEO, is a disciple of Jeff Bezos, that would make sense. You're playing the long game. If you have to move away from a story about improved bottom line performance, which for years, obviously, we talked about how the story started to change thanks to the strength of their cloud business. I think the other part here, though, is that top line. For many years, investors were okay with that because of that continued top line performance. And, you know, I'm just looking at these numbers, Tim, on the revenue story. And once again, they are posting growth at 116 billion plus in revenue, but it does appear to be the slowest revenue growth at around 7% that we have seen in 2 decades. So wow. I think that's going to invite some questions about whether or not they're a little long in the tooth.
Well, it's interesting too. We just talked with James Chakmak, who said, you know, he anticipates that we're going to start seeing signs within Amazon of getting back to double-digit percentage growth. He thinks, you know, whether it's later this year or so on, but we didn't necessarily see that in this quarter. It is interesting though, John, you know, they've already raised Prime subscription prices. They've tacked an inflation and fuel surcharge on its online merchants. So right now, it's investors who have to kind of deal with these higher costs that Amazon is dealing with.
I think that's right, Carol. And if you think about the big rally we saw for stocks today, in part based on that excitement around Meta. I mean, what did Meta really do? They certainly have a huge platform, and they were able to generate some engagement levels that kept advertising levels stable, user numbers stable, and also signal to the street that all that spending on the metaverse, well, they might be willing to temper that, right? So they went into the quarter stock under pressure. I'm talking about Meta with a message for the street. I think Amazon, by comparison, and I go back to Jeff Bezos as he's handed this baton to Andy Jassy, he's always been customer first. Not to say that he's not there to appease investors to a certain degree, but I think companies have a decision to make each quarter. What kind of message do you want to send to your investors in the immediate, you know, aftermath of these numbers? And there's nothing that's easy right now. Costs are going up. There are supply chain headaches. They're a global business. It's not an easy quarter. You made a reference to the fact that maybe things could start to improve on top line going forward. But at first blush, there's just a number of things that are challenging. But, you know, on the cloud computing side, let's not forget that is still growing at an exceptional rate. I think the sales there were up more than 35%. And so they have that luxury to play that game of, yes, passing some consumer prices along, but not fully as much as they could, and they have to take that bottom line hit. So I guess they're trying to balance that line of whatever the takeaway is on Wall Street.
John, here in the U.S., the price of Prime went up back in February. That was huge news in the last quarter, from $119 a year to $139 a year. Is that enough to offset the higher costs that Amazon faces, especially when people for years have been trained by Amazon not to necessarily shop in a way that is most efficient for the company? You heard Katie Greifeld talking about it during our simulcast. She does not click the box that says for the company to combine multiple products in one box and wait a few extra days for it. So many Americans are used to just getting that stuff when they order it, and that's expensive.
So it's so true, Tim. And yeah, I know you made some great points in that simulcast. I think that Amazon has a few loss leaders And, in theory, Prime was always that. The idea was if you get people into the ecosystem through Prime, that's going to create a moat around your business, and it's just going to mean you buy more stuff with Amazon. So I think the company, I'm not going to claim to know exactly what their thinking is right now, but I think their general view with Prime is so long as we can find a way to ensure that people stay with us a little bit longer or buy a little bit more from us, that's really all that matters right now. But I think you're right. Amazon is hitting so many different parts of the consumer now. Let's take another aspect of Prime. The fact that if you want their video service, you can buy that independently. And what did we just see with Netflix's quarterly results? We saw clear evidence that as consumers have to make choices right now, maybe they won't keep Netflix, maybe they won't keep Prime, which they had because they wanted to watch video. I still think for Amazon, all of these things were add-ons to try to make sure that they had the lead in selling stuff. And these numbers are a reminder. They sell a lot of stuff, but it's just been a choppy period as we wait for these Apple numbers. And we've seen just different flavors. The market reception to Meta today was good. We talked about some of the reasons for that, but let's not forget Netflix and Alphabet so far. It's been a bit of a company by company story so far.
Well, and James Chakmak also saying, what do you get for $140 a year when you're a Prime member? Like
Six things.
You get multiple things. So, his point was that there's value in this. So, and he's making the case, he's got a very bullish case. It's his number one position. He says it's the number one most undervalued company and likened it to Walmart years ago, who, year after year had tremendous growth. So that's kind of his take. Hey, John, we're getting ready for Apple. It'll be due out in about 7 minutes time or so. We're going to be all over it. What are you watching out for when it comes to Apple?
I think at the end of the day, Carol, how they've navigated through the supply chain hiccups, because Tim Cook, if he's got anything that he can claim as his calling card, he's the logistics machine, right? He knows how to make this business hum globally better than any other. So if they come out and they have challenges that they've dealt with on the supply chain front, if they come out and have some worrisome comments about how they've been navigating in China, such an important market for them, we know about the story of the COVID lockdowns and how that's been impacting questions around the global economy. If Apple can't make it work, I think it sends a bit of a message that for other companies, as we continue to roll through the year, it's going to be challenging. And on the other side of it, if Apple can put on that front, I think it might add to the momentum, because we just saw that huge rally for stocks today.
Yeah.
Some people are now saying, okay, well, this tech sector has been unloved for so many months. Is this the time for them to win back some of that investor favor?
Hey, John, we only have 20 seconds left with you. Can Apple tell us anything about the health of the consumer worldwide, or are the products too much at a premium to give us an accurate picture?
They're such a pricey product that they've got a pretty sticky customer base. But absolutely, Tim, I think that would be a great piece of evidence. If people don't want to keep buying pricey iPhones, that definitely is going to play into that story of consumer sentiment. We'll watch that closely.
All right, John, thank you so much. Around the tech world in, what do we do, 7 minutes or so?
Yeah.
John Ehrlichman.
That's good stuff, John. Really appreciate it. John Ehrlichman is co-host of Bloomberg Markets on Bloomberg TV, also a correspondent for CTV National News. Joining us on the phone from Toronto. Carol, we're still waiting for those Apple earnings.
Get ready. Here they come. You're listening to Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week. Apple crossing the stock already up 3% here in the after hours. A couple of the big headlines. Second quarter revenue, that was a big beat. $97.28 billion versus an estimate of $93.98 billion, and they've got a buyback.
Yeah, the company's authorizing a boost of $90 billion to its share buyback program. The company also increasing its quarterly dividend 5% to 23 cents a share from 22 cents a share. A lot of beat across the board with a lot of the numbers. We're going to get to them in just a minute and do a deep dive. First, though, Charlie Pellet, give us an update on what's happening after hours.
Indeed, Amazon, the other major story, and yes, we'll keep you covered on Apple, but right now we've got Amazon plunging 7% in extended trading. It's projecting a sluggish second quarter sales growth. The largest online retailer is struggling to build off the dramatic gains it made early in the pandemic. Another major company, a tech company reporting after the bell, Intel, the world's biggest maker of computer processors, it delivered a disappointing sales and profit forecast for the second quarter, indicating PC demand is weakening. Shares declining in late trading, down now by just about 0.5%. Again, Apple's second quarter revenue, worth repeating, $97.28 billion. Estimates on Apple, $93.98 billion. It was an up day on Wall Street today with the Dow, the S&P, and NASDAQ all rallying on optimism about earnings. Facebook today was up by 17.9%. Stocks surged the most in 7 weeks on that earnings optimism. As for the overall market backdrop, Sarah Malik is Chief Investment Officer at Nuveen.
Until we can get through the next couple of weeks and see, does the Fed up the ante, and did inflation peak in March when we get that CPI number in a couple of weeks? Those are going to be the two key indicators that tell us who wins the battle here. Is it going to be earnings and stronger economic growth, or are we still going to be worried about the Fed, continuing inflation, and these geopolitical risks in Russia, Ukraine, and China?
And again, 10-year yield right now, 2.83%. Apple authorizing a boost of $90 billion to its share buyback program. After hours, Apple now up by just about 1.9%. We've got you covered on both Apple and Amazon, Intel too. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Just some of the key numbers. I want to go back to it. Apple, iPhone, $50.6 billion.
In one category, Carol, the most important.
Right, exactly. iPad, $7.65 billion. The Mac, $10.44 billion. Wearables, $8.8 billion. And services, $19.8 billion. Our Top Live blog, our Mark Gurman pointing out, who follows all things Apple, saying services especially stand out as a record, meaning Apple TV Plus, Apple Arcade, Apple Music, and iCloud subscriptions are performing well.
There was a little bit of a miss when it comes to wearables. That perhaps means that the watch and AirPods aren't doing as well as expected.
But they're going to get a new one come fall, I thought he said, too. So
oh,
I
yeah,
do wonder
of course, the refresh cycle.
Right?
Yeah, but I think that the analysts take that into account when making their predictions.
Do they?
Yeah.
Okay.
And the iPad, seeing year-over-year decline, but still beating analyst estimates. Let's get into it with Julie Ask, Vice President and Principal Analyst of Consumer Tech at Forrester. Julie joining us on the phone from San Francisco. Julie, we've had exactly 4 minutes to digest these numbers, but investors certainly seem happy, sending shares of Apple higher by 2% in the after hours right now. What sticks out to you?
Yeah, so I think you pretty much said it. What sticks out to me is really the services.
Yeah.
I guess really two things, if I would say. One, Apple continues to perform. It doesn't matter if there's a pandemic, if there's a supply chain issue, if there's a war in the Ukraine. Apple continues to perform. And then I think certainly it's exciting to see what's going on with their services business, because the better they do there, the stickier their devices and their ecosystem becomes for the consumer.
Yeah, and it's interesting, too. As we mentioned, Apple shares are definitely rallying in the after hours. I want to put out NASDAQ 100 E-mini futures also up about 3% in the after hours, and Apple is about 12.6% of the NASDAQ 100. Amazon, which we saw sell off, is about 7% of the index, but we're seeing optimism in the after hours. I mean, this is, Julie, you know this, whenever we talk about Apple, it is a company of large numbers, and it's hard not to be blown away by them. Speaking of large numbers, they authorized a boost of $90 billion to its share buyback program. We know how that works mathematically. Is that a good move? How do you read that? Because I always think, is that really the best use of a company's money when they're buying back shares?
Well, I think, so I'm not a financial analyst, so it's hard for me to say if, like, the use case for their cash in terms of buying back shares is the right thing versus investing in R&D. But I think, if we look at what Apple's put out and what's come out of research and development, from the chipsets to improvement in cameras to the touch on the screen to the biometrics to the wearables and so forth, they certainly have a very, very strong pipeline coming out of research and development. So it's, it looks like they're making good use of the cash that they are spending.
What about when it comes to the company's moat? I mean, this is something that we talk about a lot here, is the idea that if you are an Apple customer right now, you have a hard time switching because switching costs are really high, and the Apple ecosystem
by design
is really sticky. Yeah, all by design. I mean, there are literally Harvard Business School case studies about the Apple ecosystem. Do you see the moat? Do you see Apple's moat getting bigger and getting deeper with the success that we saw in the most recent quarter of services?
Yeah, so I think so, absolutely. I think, when we think about, right, one of the points you're bringing up, not only the stickiness of the business, but where is future growth going to come from? And when we look at ownership of PCs and smartphones and tablets worldwide, certainly smartphones are saturated. Not everybody has a PC. Fewer, though. Tablets still have some upside. And then we see a lot of upside in the services business, right? We still don't see, let's say, 90% of U.S. consumers with an over-the-top streaming service for music or video. Those numbers are quite high, but not as high as the hardware platform. So they've still got some upside to go. But otherwise, I think the stickier their services get, they're going to get new customers just from, consumers and teens aging into iPhones that their parents are going to buy for them. And there's certainly, with the innovation that they've done and the quality of the features and the speed and the flashiness and the quality of the cameras that they're pushing into devices like lower-end smartphones, is bringing more consumers into the Apple ecosystem. So a lot of strong growth ahead, I think.
Well, Julie, and listen, you talk to a lot of other companies. You follow this space more broadly. I can only imagine how many other companies are out there like, okay, how do I do what Apple does? I mean, put them in perspective from somebody who consults with other companies, provides research for the overall industry. How do we need to continually think about Apple in our world?
Yeah, I think that's a really good question, because I think, one of the things that Apple's always done is it's always focused on the consumer experience, right? And it's delivered high profits for them, but they have never been the lowest cost selling smartphone. They've done some things that have been unpopular, I think, with folks in the industry, but not with consumers. They don't have as much of an open ecosystem as others do. They have a lot of rules. They have a lot of tight control over the experience that they're offering to consumers. And so I think if there were, a big takeaway for others in the industry, whether it's in their industry or around their industry, is that the user experience matters, and consumers are willing to pay for that.
Well, I want to talk more about growth in the next place that Apple can see that growth. When we think about hardware specifically, Julie, what do you think Apple does next? Our own Mark Gurman has reported that the company is working on augmented reality. And of course, there have been reports about a car, all of this stuff years away. Where do you see the biggest area of growth when it comes to hardware?
So I think this is a tough question, because I don't see it, again, following the industry for a long time, there isn't a next device like the smartphone that's looming on the horizon. So what I will expect to see is, well, yes, lots of people have computers, almost everybody has a smartphone. I don't know that we're going to see the next device where we see 50, 70, 80, 90% adoption worldwide by consumers. So what I would expect to see is the watch. It's hovering at about 10% of U.S. consumers have a smartwatch today. Maybe we see that number double. Augmented reality glasses come out. Virtual reality headsets come out. We'll see. I think that's still a few years away before we see something like that at mass market. But then maybe that crawls up to 5 or 10%, and then maybe there's a car and there's another device.
Right.
So I think it's going to be more about the portfolio looking in the future than the device.
All right, we're going to leave it there. Hey, Julie, thank you so much. Julie Ask, she's VP and Principal Analyst of Consumer Tech over at Forrester, on the phone in San Francisco. We're going to stay in San Francisco because that's where we find the host of Bloomberg Technology, Emily Chang. She caught up with Apple CEO Tim Cook and the company's CFO. Hey, Emily, great to have you here. Apple is out. What did Mr. Cook have to say?
Well, Carol, he underscored just what a record quarter this was, as you were talking about with Julie Ask, all-time record for services, a quarterly record across almost every single category, which is pretty impressive given the macroeconomic forces that all big tech companies are facing: inflation and an ongoing war and rising gas prices. So he talked about how they grew in each of their product categories except for iPad, where they face significant supply constraints. And I honed in on what supply issues they're continuing to face. He wouldn't give us any color on what's happening in the current quarter or what he expects for the rest of the year. But he said for last quarter, it was significantly lower. The constraints were lower than what they experienced in December. They were all basically chip-related constraints, which affected several of their products, and I'm going to be looking on the call for any more insight on how those constraints are playing out right now and how he expects those to play out for the rest of the year. In terms of the macro environment, he did talk about how, they're seeing that inflationary pressure. You can see that in their operating expenses and their gross margins. They're navigating that as best they can. He said, I was looking for a specific number on Russia. As we know, Apple paused all product sales in Russia. He said he would give us a specific number on that on the call.
Does it seem like, Emily, supply chain constraints are easing for the company? Was that the impression that you took away from your conversation?
So, look, we're still seeing product delays if you look at the MacBook Pro in particular. So, it is still impacting products right now. I can't speculate as to, what he's seeing in the current quarter. I will say, for example, we saw Qualcomm results yesterday, and I'm going to be interviewing CEO Cristiano Amon on my show today. He says he expects supply constraints to ease before the end of the year. He thinks the China lockdown issues will shake out in the current quarter. We'll have to see if Tim Cook gives us more insight on whether that's the same for Apple, but something to listen to. Another interesting question is, of course, streaming. And Apple has made a big bet on Apple TV Plus. But over the last quarter, we've seen Netflix lose subscribers for the first time in a decade. We saw CNN Plus abruptly shut down. And there are these broader questions about the future of the streaming market. He says he's still very bullish on streaming. He, kind of doubled down on the philosophy for TV Plus, which has been to, as he puts it, create high-quality content that aligns well with their values and be one of the most desired platforms for storytellers. He said, I feel we're doing a quote-unquote pretty good job of that. He pointed out Coda, which of course won the Oscar for Best Picture, and I would say is an extraordinary film.
The movie too. I loved it.
It's so good, so good. I cried so many different times in that movie for different reasons, all of the different relationships, and also Ted Lasso, which has racked up a few Emmys.
They do have a lot of feel-good content.
The morning show, not bad either. It's amazing. They kind of came in and and slowly I feel like they've built momentum. It's funny that you talked about doing good, because he did say in the press release, he talked about strong customer response to products. He says progress we're making to become carbon neutral across our supply chain and our products by 2030. So you put that out front and center. Emily, you've been covering the tech space for a long time. You've been covering this week, the last couple of weeks, where we are seeing so many cross currents in our environment, geopolitically, market-wise. We're talking about some of those big macro issues out there. How would you then place these Apple results against that backdrop?
Look, Apple seems to be fairly well insulated from what's going on in the rest of the world. And you would think that, issues with inflation, the war, specifically in Europe, would mean people are buying fewer gadgets, buying fewer discretionary things. But in fact, we saw quarter over quarter, year over year revenue rise in Europe despite the ongoing war. And I would say that most of the issues we're really seeing are with the advertising business. So we saw that with YouTube. We saw that with Meta. We saw that with Snap. We saw that with Twitter today. Well, Apple doesn't really rely on advertising revenue. And so Apple's product portfolio, along with its services business, seems to be holding up very well in this macro environment.
I'm so glad you brought up services. It stands out as a record. Apple TV, Apple Arcade, Apple Music, iCloud subscriptions, they're performing well. This according to our own Mark Gurman writing on the live blog of Apple earnings. $19.8 billion, Emily. Did you get any insight from Tim Cook about an area of services that the company is most excited about? Would you say that it is Apple TV Plus, despite the hiccups that we've seen in streaming of late?
Apple TV Plus is definitely something that I think it's like one of those crown jewels. It's bright and shiny, and it's fun to talk about and fun to watch. My guess is if we honed in on it, he wouldn't necessarily pick a favorite. There's also Apple Pay. There is Apple Music, as you say. But services has really been Tim Cook's baby from the very beginning. It was, years ago that he made a bet on this business as a big future revenue stream for Apple, and a lot of people doubted whether Apple could really grow something like this. But now you're seeing it, 20% of overall revenue, and the services business is in part driving demand for the products. And so that's how the portfolio is all working together and working very well together, at least based on this quarter's results.
So what do we want to know in terms of where, future growth comes from, Emily? Like, for such a long time, remember there was a period where we were having a conversation for years. I felt like, oh my God, all they have is the iPhone. Well, it's okay. And they have expanded, into other areas. What do you want to know about where future growth comes from?
Well, an iPhone, by the way, is still a significant portion of revenue. So, we can't forget that. Julie was talking about a car. Who knows? Is Apple really going to go big in automotive? My colleague Mark Gurman has been writing a lot about Apple and augmented reality. Is there a big future there? Gaming is an interesting one. Apple Arcade, we haven't seen big tech giants really have major success in gaming outside of the big gaming studios, which is why you're seeing Microsoft trying to buy Activision. I think with Apple, it's a lot of, just more of what they already have. It's not necessarily a new product category. They've shown they don't have to do that necessarily to keep growing. But it's always the big question. What's the next big thing for Apple going to be? And nobody knows for sure.
What questions do you think, Emily, that analysts will have today about Greater China sales and Greater China in particular? And not just from the perspective of sales, but also from the perspective of it being an area of the world where a lot of Apple products are manufactured.
Absolutely. Well, the lockdown is ongoing. Just in the last couple of days, we've seen more factories close, specifically in the Shanghai area. He said he'd give some more color on, the broader supply constraints on the call. In terms of sales in Greater China, we still saw big increase year over year. So it's still growing at a healthy clip. And China will continue to be a huge market for Apple. I will say that Cristiano Amon, the CEO of Qualcomm, has said he expects the China lockdown issues to shake out over the next couple of months. But it's still there in a very big way, and so you have to expect that's going to impact Apple in some way.
It does feel like Apple's firing on all cylinders. Stock's still up in the after hours, although trimming some of those gains. It's still up about 0.9%. Anything, Emily, in your conversation with Apple's Tim Cook that gave you pause?
He talked about the supply constraints which mostly impacted the iPad. I think that's going to be the big issue for the rest of the year. How are they going to continue to navigate this? There are so many different suppliers and components involved in making one, big, bright, sparkling Apple product. But, Tim Cook himself is the guy that really built Apple's supply chain, so he knows it better than anyone else. And I think based on these numbers, we could expect Apple to continue to navigate that pretty well, despite the issues that, the rest of the world is facing.
Yeah, it's pretty remarkable. Emily, we love you. Thank you so much. The host of Bloomberg Technology. Catch her at 5 p.m. Wall Street time on Bloomberg Television. Be sure to also check out her podcast. And we'll also be looking for some thoughts on the outlook from Tim Cook on that call, because we did not get that in the release.
Yeah, looking forward to that all coming a little bit later. Let's now get to Charlie Pellet with a check of what's going on in the market. Hey, Charlie.
Well, hello there. Turned out to be an update for the Dow, the S&P, NASDAQ, but earnings, lots of them fast and furious after hours. Let's reset here. First of all, bringing you up to date on Apple, the stock up 1% after hours. As we heard from Emily, as we've been reporting, second quarter sales and profit did top analyst estimates thanks to strong demand for the iPhone and digital services. The company also announced that $90 billion in new stock buybacks. Amazon, though, plunging after hours. Amazon.com didn't deliver for investors, down about 9.5%. Amazon is projecting sluggish second quarter sales growth as the largest online retailer struggles to build off of the dramatic gains that it made early in the pandemic. Intel, the world's biggest maker of computer processors, also delivered a disappointing sales and profit forecast for the second quarter, indicating PC demand is weakening. Briefly, Goldman Sachs is offering its first ever lending facility backed by Bitcoin in a significant step for a major American bank that accelerates Wall Street's embrace of cryptocurrencies. S&P up 103 points today, up 2.5%. 1%. The Dow up 614, up 1.9%. NASDAQ up 382, a gain of 3.1%. 10-year yield 2.83%. Spot gold up 0.4%, $18.94 the ounce. Crude up today by 3.1%, $105.18 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie. Thank you so much, Charlie Pellet there. I mean, wow, what an
What a
weekend
week.
earnings. Yeah, and just even today, the contrast between Amazon and Apple, obviously not the same companies, but Apple shares, we know, still holding on to about a 1% gain. What I'm looking at, though, Amazon. Oh, actually, Amazon's now up about 1%.
Oh, I'm not seeing that in my
Oh, wait a
after
minute. No,
hours.
I'm
Yeah,
sorry,
seeing
that's
it down-
Apple. That's
I'm
Apple.
seeing it down 10%. Well, it is a tale of two different reports. Go ahead.
No, what I was going to say is that even with that 10% decline in Amazon and Apple up just about a hair, about 1%, we're seeing NASDAQ 100 mini futures. They're up, E-mini futures are up about 2.3%. So we're seeing some enthusiasm.
effect.
It does feel like that.
Yeah, I mean, I think you saw it similarly play out with today's trade with the effect for Meta Platforms, the company formerly known as Facebook. Even though Facebook shares, going into yesterday were down 50% from the
Right.
beginning of this year, there was a little optimism that, okay, well, the company had returned to actually gaining users.
Right, because it was so bad the previous
so
quarter.
bad.
And that really caught people off guard. So
Yeah.
I do think, I know I've said it over and over, I think we all did, like a sigh of relief after that report that they weren't, continuing to lose ground there.
Exactly. Hey, let's do a rehash of what we saw with Amazon. We heard it from Charlie. We talked a little bit about it earlier, a lot about it earlier. Shares tumbling as quarterly sales forecast missing estimates. Inflation, Carol, is eating into the low margin business. The company's CEO, Andy Jassy, right now focused on improving efficiencies when it comes to warehouses. I think there will be a lot of questions from analysts about how things are at warehouses because employee relations has been an issue for the company of late.
Yeah, absolutely. Employee issues, costs. I mean, they've got higher labor costs, logistics, fuel for all the delivery stuff, and then there's just supply chain problems and snarls that is certainly impacting everything.
By the way, it's not just an Amazon issue right now with the
No.
unionization push, right?
Yeah.
You have employees looking to do it at Apple stores here in New York and Grand Central, and then you also have it at Starbucks, and you see Howard Schultz at Starbucks really focusing on that.
So you wonder, like, how do they manage through that? They've already raised Prime, right? They've already raised the prices of certain things. So now where do how do you make up the difference and cover some of those costs?
Does it just come to higher costs for those actual individual items?
Don't you
if
ever?
the convenience of Amazon outweighs the if you can find it somewhere else, if you can find something else somewhere else for cheaper, but you have to create an account, you have to go in and enter your email, is that worth it to somebody?
But how much of you as a household, because you pay for Amazon Prime, you're like, well, just order it on Amazon.
We don't even look anywhere else.
Right, because you're like, you don't pay anything for shipping.
Yeah.
Right?
Well, that's what Mark Lorry wanted to do with Jet. He wanted to come in and change the way that consumers thought about shopping and offer actual better prices than Amazon. And what he said for years, and then he went to Walmart when Walmart bought Jet, was that he can do it in a way that provides more efficiencies for the consumer.
Yeah, I mean, this is interesting. I will say, what Katie said about, I don't check the box where, put it all together. I am increasingly doing that.
I do it.
It bothers the heck out of me that, I get some little item in a huge box. There's the packaging materials, there's the cost, and there's the delivery that's involved in that it just doesn't make sense. It kind of just bothers me.
Yeah, I agree with you completely. Let's talk a little bit about Apple.
Yeah, let's do that. Second quarter sales and profit topped analyst estimates, fueled by strong demand for the iPhone and digital services, and the company announced $90 billion in new stock buybacks. Our T-Live blog saying that that's pretty typical that we see that kind of amount announced by the company. I think that happened similarly maybe a year ago. But sales in the period up 8.6% to $97.3 billion, a record for a non-holiday quarter. That's why that's interesting, too.
iPhone sales topping estimates after that March SE 5G rollout. That's the iPhone. China sales growth slowing to the weakest since Q4 of 2020. I expect calls from analysts about that region of the world specifically. The company, as you mentioned, announcing $90 billion in new stock buybacks. And the net services, a real bright spot. Record revenue for the company for services, now about 20% of the company's revenue. That's propelling earnings per share and revenue past analyst estimates.
Do you want to mention Intel? Because they also reported after the closing bell, the world's biggest maker of computer processors, reported lackluster quarterly revenue in its data center business and gave a disappointing sales and profit forecast for the current period. So that's indicating some weaker demand for its chips across the board. And we did see the stock under pressure. I mean, the SOX was certainly an outperformer thanks to Qualcomm in today's regular session. Intel down 4.4% in the aftermarket.
All right, back to Apple for just one more that I'm seeing on our live vlog here. Tim
What?
Colpin of Bloomberg Opinion is saying that shortages are going to be in focus. And even though Tim Cook is has previously said that supply constraints are no fault of Apple. Tim Colpin at Bloomberg Opinion says that he disagrees. He thinks that Apple has way too much of its supply chain concentrated in one region, one country, and he should know it.
Well,
because he used to run supply chains.
We talk about this all the time, right? It's exposure to China, and especially with the tensions that we've been seeing.
That's what I was asking Emily
change,
about.
Right?
Yeah.
And what happens as a result of that? Because they've been pretty steadfast in terms of their exposure there. I mean, they have a lot of investments there.
They do, and they're suppliers too, because it's a lot of contract manufacturing as well.
Right? Yeah, that's a really good point. All right, NASDAQ E-mini futures, NASDAQ 100 E-mini futures still up about 2.5% here in the after hour. So we'll see whether or not this positive momentum that we're seeing at least broadly carries over into the Friday trade.
All right, that was a good week.
It was an amazing week. And next week's going to be interesting, too, because we get some big...
I'm not here tomorrow.
You're not? That's
I'm not, but I will see you in California, Carol.
We've got Milken coming up. We're going to be there Monday, Tuesday with some great interviews. I'll be here tomorrow, though. Tim's going to get on a plane tomorrow, get out there a little bit early. For the whole Bloomberg Business Week team and Tim Stanovic, I'm Carol Masser. Have a good and safe evening, and this is Bloomberg.